Hello, everyone. Today on the final bar, we'll hit the market from three directions: top-down macro, bottom-up stock picking, sector rotation. When we start with the macro picture, I wouldn't say it's changed, but it's certainly accelerated to the downside today with the NASDAQ selling off 2.5%, the S&P finishing down about 1%, the Dow actually finishing in the red. So certainly more of a risk-off feel through the course of the day. No real bid coming in during trading today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the power of technical analysis, using stock charts to break down and understand the market dynamics, focus on the investor decision-making and behavior, all of those things that cause buyers and sellers to take action. Certainly today, more sellers than buyers, anecdotally, with certainly a good amount of distribution through the course of the day. You know, the morning session was relatively calm, sort of choppy, but then it really accelerated to the downside. You know, I haven't looked, but I didn't see a ton of news flow causing it. It was more just a general distribution, a continued rotation away from growth and into value. And if you look at things like homebuilders and Home Depot and steel stocks, they look great. But if you look at other sectors and groups, not as rosy. Particularly, we'll look at semiconductors, some of the FANG stocks, and many others through the course of the show today. A lot of great content in terms of our guests. We had some really great guests last week. Enjoyed talking about the NASDAQ with a number of very knowledgeable experts and strategists. This week, we have Jay Soloff from Investors Alley on Tuesday the 11th. On Wednesday the 12th, Bob Lang from Explosive Options. And then on Thursday, May 13th, Chris Brecher from Brecher Trading. Also, as a reminder, we have the Money Show coming up, the Money Show virtual event this Wednesday. We've enjoyed being involved with the Money Show in a number of different events. I will be speaking this coming Wednesday, the 12th at 1:30 p.m. Eastern. My presentation is actually called 3 Ways to Upgrade Your Routines and Improve Your Returns. We're going to talk in particular about how you spend your days, how you spend your weeks. I've often found that the most successful investors I've worked with just surround themselves or put into practice really consistent, good routines. And I've often told people a consistent, imperfect routine is way better than an inconsistent, perfect routine. We're going to talk about some of the ways to incorporate some discipline into your daily and weekly process. So join me there for the Money Show virtual event. Let's continue on with our market recap. So as I mentioned in the introduction, certainly the key word for today, I would argue, is distribution. You saw sellers really taking control in the afternoon, and stocks accelerated to the downside. One big push sort of after lunch, and then another sell-off going into the close. And that really indicated sort of a risk-off measure. If you look at the sectors that work today, it's utilities, consumer staples, and real estate. Now, while other days it's been more about offense and just where you're going. Is it value over growth? This was less about value over growth and more about, I would argue, risk off versus risk on. Things like technology, communication, services, consumer discretionary, all down fairly significantly, while utilities, consumer staples are actually up on the day. So again, this was a little different character than what we've seen. And coming out of the weekend, where the S&P sort of at or near all-time highs, pushing to the upside to finish strong, today was more of a reminder that all is not perfect and that there are plenty of signs of weakness. This euphoric sentiment that we've seen, the overextended market conditions, the bearish divergences, all sort of capitulating, it looks like so far, with a nice distribution. Now, again, if you look at the chart of the ARK Innovation Fund, for example, or some of the stocks that would be big holdings in there, distribution on a day like today, especially led by technology, should not be too much of a surprise. We've seen this pattern up until today. But let's look at the market today from three different pieces. Let's start with a macro environment, focus on the big picture. So thinking of that, the NASDAQ down 2.5% today, the S&P down 1%, the Dow down just a rounding error below zero. earlier in the day, as I was preparing for the show, I was ready to share this traditional experience we've seen with the NASDAQ down, the Dow up, and the S&P in the middle. What happened through the course of the day, though, is all three of those were dragged lower and lower. So the weakness in tech communications names really dragged the rest of the market down. Mid caps, by the way, down about the same as large caps. Small caps down a lot more significantly, and the VIX is nearing back up to the 20 level, which was, in 2020 was essentially the low for the VIX for the course of the year. 10-year yields pushing back up around 1.6%. It's not a huge move, about 25 basis points up from Friday. And the TLT, which we use usually as a proxy for bond prices, down about 1%. The dollar, by the way, was flat for the day. Commodities overall down, and energy was essentially a wash for the day, but oil prices were flat as well, just a little bit up. But gold prices were up about 1/3%. It was one of the few bright spots looking across the global markets. All the cryptocurrencies essentially ended lower, and a lot of them accelerated to the downside just in the last hour, with Bitcoin currently down about 6% from where it was over the weekend, down around 54,500. Ethereum, by the way, was one of the few that was in the positive, but you can see it rolling over pretty aggressively. So you're certainly seeing, if your measure of risk on or risk off is cryptocurrencies, you're certainly seeing a move more towards risk off right now. Let's continue to walk through some of the big picture charts. So where are we at overall? And by the way, we missed Friday's show, and I'm sorry about that. Actually got coronavirus vaccine number 2 on Thursday. Started to feel some of the ill effects on Friday, and so I had to take a little bit of time off. Feeling a lot better today. We did not make our normal Friday routine of going through the Mindful Investor live chart list. So just what happened, just in case you're curious, my market trend model that I update every Friday after the close actually remained bullish across the board. Now, again, this is a model built on the trend. This is telling you what the trend has been up until this moment. And again, when the S&P is making a new all-time weekly high, a closing high for the week, and finishing strong on Friday, I can accept that the long-term, medium-term, short-term trends all bullish along that mark. Given the distribution we've seen today, if we would continue to see some distributive patterns through the course of the week, here's what would normally happen. The short-term model would be the first thing that would turn if we close below the 5-week exponential moving average. That's the green line up there in the top panel. That would trigger a short-term bearish signal, which hasn't happened really since February. Last time it happens when you had about a 5 to 6% pullback there in February. Since then, we really haven't had anything like that sort of pullback. What we've talked about up until today is that market's certainly overdue for that sort of movement. And going to the daily chart of the S&P, this bearish divergence that we noted here in recent weeks, which is the higher highs going into the end of April, the lower peaks in RSI, to me suggests high likelihood of sort of a 5 to 10% correction. That's sort of what we got here in January, which is the last time we had a bearish divergence like that. Sold off to the 50-day moving average, around 4.5%, I think, just under 5% to the lows, but it hit support right at the 50-day moving average. That 50-day, by the way, right now is around 4,040. The trend line here, taking the lows from October and March, by the way, not too far from there. So sort of that 40, 50, 40, 4,000 range is sort of the area for support. But first things first, you have to break a swing low to sort of trigger that potential downside. So 4120, I would argue, still remains the line in the sand. That's that pink line. You can see we tested that about a week ago. That was earlier last Tuesday, I want to say. So overall, looking for support there. But if we break that, that indicates higher potential for further downside. Given the distribution that we've seen today, I would not be surprised if we trigger that sort of downside move. By the way, we just have time for one more thing, and then we'll wrap this segment up. But I think it's worth noting when you're thinking big picture, Dow theory, which looks at the Dow Industrials and the Dow Transports, both big thumbs up. And the strength in transports, that's airlines, that's railroad stocks, that's a bunch of other things that fit into transports. But both of these have confirmed an all-time high not too long ago. But if we look at what's called the new Dow theory, which is looking at the S&P in the top panel and the NASDAQ composite, in the bottom panel, you can see you've had a non-confirmation, which is the S&P going to new highs in April into this month, but you're not seeing a confirmation of new highs from the NASDAQ composite, which now has failed twice around the 14,000 level, just above there. So until the NASDAQ composite can get above there, that's actually a non-confirmation, indicating that these two main pillars of the economy, the S&P representing the old economy and the NASDAQ composite arguably representing the new economy, not confirming. That's not a doubt theory sell signal, by the way. That's, you'd have to see some breakdowns a lot further below where we're at. But at this point, I would argue it's a non-confirmation, overall negative for sure, indicating some weakness, obviously, in technology. That's our market recap in terms of the big picture themes. Let's continue on and go to sector setups, which is where we focus on the 11 S&P sectors and how they're rotating around the benchmark in the middle. To start with, we always use the RRG. This is the relative rotation graph that my friend Julius de Kempener created years and years ago. If you're not familiar with this, we don't have time to go through all the mechanics of it, but essentially, we're looking at the 11 S&P sectors rotating around the benchmark, which is there at the crosshairs, and things rotate in a clockwise direction. Look up Julius's show called Sector Spotlight. It's really well done. He talks a lot more about ways to apply this in your own analysis of the markets. But for me, I'm looking at the bottom, which essentially ranks in order the strength of these rotations, the strengths of these trends, and essentially focuses on stocks in the leading quadrant or sectors here in the leading quadrant, which are things that are outperforming on improving momentum, right? So it's outperforming in recent weeks, but also it's accelerating to the upside. The momentum is in good shape. Compare that to things in the weakening quadrant, which are still outperforming, but the rotation is starting to go down, right? So they're less resilient in their uptrends, if you will. So the three top sectors, according to this, are industrials, materials, and real estate. And real estate has come off a little bit in recent weeks. If you've looked at the chart, we'll look at here in a minute, but you see the relative strength has come down. But overall, these are the three strongest sectors. The things that are emerging, things that potentially starting to come up in the leading quadrant. This is using the weekly data, by the way, so it's a little longer term. You'll see things like utilities, consumer staples, and now starting to see healthcare and consumer discretionary rotate into the improving quadrant. So these are things that have been underperforming, but are starting to improve on a relative basis, on a momentum basis. And potentially that's where you see some opportunities arise. What is by far the weakest of the 11 sectors using this methodology? It's technology, the XLK, which is the only of the 11 S&P sectors now remaining in the lagging quadrant. So when you see this rotation into things like energy and financials, those have been in the farthest right side, still relatively strong, but you can see financials and energy, the momentum is coming down. That's why they're rotating down to the southwest direction. The things that are improving the most, in my view of this rotation, are industrials, materials, and real estate. Let's look into the 11 S&P sectors using the candle glance function. This is where we can throw all 11 sectors, their charts as little thumbnails, and start to make some comparisons. You know, in recent weeks, if not for quite a while, we've been talking about this situation where all 11 S&P sectors are above two upward sloping moving averages. I was allowed to say that once energy actually regained its 50-day moving average, rotated back above its 50-day there in the last week in April, confirming that all 11 S&P sectors are above their 50 and 200-day moving averages. Now, if you note across the charts, there is one that is now threatening to ruin that scenario, actually back below its 50-day, and it's technology here, the XLK, right? So while the chart of the XLK isn't horrible, guy, right? I mean, if you look in the last couple of weeks, it's coming off of all-time highs. The XLK got up to around 143, broke to new all-time high there in April, early April, retested that same level and created what could arguably become a classic double top pattern there in early April to late April. We then broke the interim low, which you might call the neckline, around 140 the last week in April. And now we're making a lower low, and now we've potentially made a lower high with technology coming back down. It's now threatening to break its 50-day moving average. I think if it does that, I think it's on a relative basis pretty weak. And you can see the relative line here at the bottom. Look at a sector that rotated from accumulation phase to consolidation phase on a relative basis, which is more in line with the market, a market performer, to all of a sudden distributing, right? And it's making a new almost 12-month relative lows, maybe a 10-month relative low that we're making this week. But look at this rotation now, the relative strength making lower highs and lower lows, indicating not that the sector overall is losing value, right? The XOK is gaining. This relative strength going lower is just there are much better places to be. So with that chart in mind and that relative chart in mind, let's look at another sector which emerges one of the strongest, which is industrials. Look at how the relative strength is making new swing highs, right? So while the relative strength on technology making the lower lows and lower highs, this is doing the opposite, making higher highs, making higher lows. This is in an uptrend. If you look at the industrial sector, really starting in the second quarter of 2020, the sector's overall been in a pretty good uptrend. So when you're looking big picture, you're looking long term at sectors which are outperforming, sectors which are putting you in a position to outperform a passive holding, outperform just the spiders or the Qs or something. Sectors where the relative strength line is going up, those are the sectors that are going to do it for you. And so industrials making a new relative high yet again this week, making a new all-time high yet again this week. I think that's where you're seeing a lot of strength, a lot of long-term strength, and certainly some outperformance. Two other sectors to highlight here very quickly. Consumer staples is one. So this is one on a relative basis, which has not been super impressive. If you remember the chart of technology, which was outperforming and then market performing sort of sideways, and then the relative strength was going down, consumer staples had been in a relative downtrend really through March. Then you can see how it's stabilized, right? So if you look at the last 3 months, you've actually made about the same as the S&P itself by owning consumer staples. You can see the sector making new highs, the relative strength starting to turn higher, not really impressing yet on a relative basis in terms of making new relative highs, but you're seeing strength on the chart. And I think that's where you want to look for stock picking opportunities, away from growth and into value. That's why you're seeing things like financials, industrials, energy, materials doing very, very well. You are also seeing strength, I would point out, in defensive sectors like real estate, in sectors like healthcare, which a lot of people have been ignoring, and also potentially utilities coming out and starting to outperform. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we look at these markets using the charts. I would argue if you have just one thing to try to make sense of a stock or an asset class or a theme, look at the chart. The reasons why the charts do what they do, the reasons why trends persist usually become very clear in the rearview mirror. Let's focus on the message that the charts and the markets themselves provide. Having said that, we love to hear from you, particularly answering your questions that come up in your own process of analyzing the market. So anything that comes up, shoot us an email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, also on our YouTube channel. Just put a comment below the video that you're watching. We'd love to answer one of your questions in our next mailbag segment coming up at the on Tuesday's show. We'll also do another one on Friday. Also, as a reminder, go to stockchartstv.com, use your email, set up a free account. You can start consuming all of our great content from our hosts and special guests for free. You can also find us on all of the app stores. Just search for StockCharts TV on demand. Our next segment is called Shifting Stocks. This is where we focus on individual names. We talked about the big picture, the rotation from growth to value, but really today more of a risk-off move. We've talked at times about, by the way, the strength in gold and the resilience of the gold trade. I actually want to start there. We have a number of stocks here looking. There's one of them that was actually reporting this week. Kinross is reporting tomorrow, KGC. So I have to see what happens there, but I'm interested by the chart of Newmont Mining. When I'm looking at stocks making new 3-month highs, something like NEM pops up on the screen here. And I can tell you, it's been a while since Newmont has popped up on the new 3-month high screen. I regularly look for stocks making a new high for the quarter and also stocks making new lows for the quarter. It often will help you indicate or identify stocks just starting to rotate higher or lower. And it's interesting when a group that has not been on the list, and gold stocks are certainly one of those, all of a sudden they start to pop up. So NEM making a new swing high in the last week, now continuing this pattern of higher highs and higher lows back above both the 50 and 200-day moving averages. Some would notice what's called the golden cross, which is when the 50 crosses up through the 200-day. I usually focus very little on that, only because when I have back tested that, I found it to not be a great way of timing things. I think that's more anecdotal than anything. For me, the stock being above its moving averages is much more of an important signal. I think the stock getting above its 50 and 200-day, retesting the 200-day from above, and now making another new swing high, the relative strength starting to improve means gold stocks potentially setting up for further upside. And it's very easy on a chart like this to use a trend line taking the recent lows. As long as we remain above that trend line, the chart is in decent shape. So Newmont Mining is actually an interesting one to start with. Lots of strength in materials, industrials, and elsewhere. Let's look at some of the areas of weakness that we've seen today. When we're looking at the consumer discretionary sector, we talked about the rotation away from the sort of offense in the form of consumer discretionary. That really, if you look at the XLY, if you would buy the XLY, you're getting concentrated exposure in three particular stocks: Amazon, Tesla, Home Depot. Let's look at each three of those very quickly. So Amazon number one is where we're looking at this a chart which is really transitioned from accumulation phase to consolidation phase. If you look on an absolute basis, you can see that half of 2020, really even including the sell-off that we saw in March 2020, overall was part of a much longer term move to the upside that really accelerated in April and continued on through the peak in September. The stock hit a peak just around 3,500 there in September, retested that same level around October, got close there in February 2021, but then failed once again there around 3,500. This was just about a week and a half ago. So overall, you have a stock that has gone from accumulation phase to consolidation phase. If you draw a line around 2,900 on the lower end, 3,500 on the upper end, you get the range of Amazon and also relative strength that has been consistently underperforming. So while consumer discretionary has done okay, Amazon has certainly not been part of the success story there. Now you compare that chart, which chart number two, Tesla. So this one overall also has transitioned from accumulation, arguably now more into distribution mode. Here we can see a stock that's obviously been in a consistent uptrend, remaining above its 50-day moving average for much of 2020, especially after the March 2020 lows. From there, it broke the 50-day for the first time in February of 2021. And since there, that peak from late January really has been the high. It failed there once again in February, since then rotated lower. Since then, and this was a bit of a head fake, got back above the 50-day moving average, a nice rally day, getting above the neckline of this rotational period. But then that close, if you look at the break above the 50-day, that's the highest close we've seen since then. The last month has been lower highs, lower lows, and I think threatening that 200-day moving average is very much a bit of concern. Compare those two charts with Home Depot, which made a new all-time high today. So the sort of the infrastructure trade, things like home improvement retailers, home builders, something like the ITB, which includes things like Home Depot and Lowe's, but also all the traditional home builders like Lennar and Pulte and all those others. These are the stocks making new swing highs, continuing to push to the upside. These are the stocks that are holding up very, very well. So given the option within consumer discretionary to own the entire sector, which puts you into a lot of the growthy part of the sector, instead of owning stocks like Amazon that have failed to break out of their range, or Tesla that arguably are rotating back into a downtrend, I'd much rather own charts like Home Depot that are rotating back to the upside. Where else can we go? You know, I've mentioned this chart before, the ARK Innovation Fund, and this is my quick way of saying basically most things in this most of the holdings have a similar pattern to what you saw with Tesla, right? These are stocks that have attempted to break out. Many of them sold off, and then we're tapering into a range. And at this point, you can question whether the growth thread is dead or not. You can start to think, are we going to reemerge? Are we going to break above the 50-day, break out of this range to the upside as the ARKK get above 130, which would indicate maybe a rebirth of that growthy sort of long-term trade. And while I think many of these stocks could absolutely work over the long term, the fact that ARKK is below its 200-day and is broken below that range to the downside indicates to me that the trade for now is really exhausted, right? This is more of an indicating further downside potential and measures a lot lower. Now, what's interesting is the ARKK now is oversold for the first time since last March or since March of this year. There you had certainly a tactical bounce before a range-bound period. Be interesting to see if you get a bounce out of oversold conditions, but overall, I would argue the long-term trend still weaker rather than stronger. The last chart we're going to be able to look at is semiconductors, SMH. This is what I often consider a leading indicator for the markets as a whole. When semiconductors are doing well, the market overall can't be doing that badly because it's a central part of the functioning of, I would argue, the new economy. If you look at the chart of the semiconductor complex, you see an uptrend through February. You see a consolidation phase, a peak reached in February, retested and failed there in April. We're now rotating back lower. The group is down over 4% today. So while not breaking down, it's no longer going higher. These are signs of trend exhaustion. By the way, this is after a glaring bearish divergence there in January to February, higher highs comprised lower peaks in momentum. Now we're seeing the relative strength making a new 5-month low, and overall that does not bode well for the group, for semiconductors, but also for the market as a whole, telling you the growth trade needs further downside backing and filling. That's our shifting stock segment. We need to wrap the show. Go to the 3 in 3, which is 3 charts in 3 minutes. Here we go. Chart number 1 is the ratio of consumer discretionary versus consumer staples. We dug a little bit into the largest holdings in the XLY, 3 stocks: Amazon, Home Depot, and Tesla. And 2 of those 3 look relatively weak and are threatening to break down. One of those, Home Depot, indicates the strength in that infrastructure trade. I think the PAVE ETF might be a great way to focus on some of the bigger holdings, some of the stocks that have been working. Overall, it's interesting that the cap-weighted version of consumer discretionary versus consumer staples really rolling over in the last week. And I think that speaks to the weakness in Amazon, which is weighing heavily on that ratio. The equal-weighted version, by the way, made a new swing high at the end of April, rolling over just a bit. So overall, still fine. And I think the average consumer discretionary stock still doing just fine versus the average consumer staple stock. But if you want a read on not just rotation from growth to value, but more about rotation from risk on to risk off, this is one of the ratios that I would be following. Overall, still holding up okay, but that's certainly a leading indicator I would pay attention to. Chart number 2 is the relative strength of semiconductors, the SMH. This relative strength ratio, by the way, is below its 200-day moving average as of today for the first time since June of 2019. That's how long this has been in a very long-term uptrend, indicating the strength in this group, the leadership of growth stocks, the leadership of technology. Look at how that has changed. And if you start the clock in mid-February, this group has been underperforming by a pretty decent clip, with a nice bounce in March, but overall weaker versus stronger. And the relative strength weakening in that group overall, I think, is a negative sign for technology, a negative sign for the growth trade. I would also suggest that, can the market do well overall with a group like semiconductors looking that bad? I don't think so. I think this weighs on the S&P overall. Finally, what groups are working? It's often a great idea when you see the market selling off to look at what's working. When you see everything rallying, look at what is not working. It's a great way to focus on alternate scenarios, look for opportunities for differentiation. Here we're seeing the U.S. Steel Index making a new all-time high today, right? This is today's trade, making a new all-time high. This is using the Dow Jones Steel Group on the system. Stocks like Nucor, NUE would be good representatives of that group, by the way. And very quickly, if you look at the chart of the NUE, and I'm doing this for today's producer, Zach, who won our StockCharts TV stock picking competition. I did not win. And stocks like this rallying just after we ended the competition, it's brutal. But steel stocks are working, and that's the chart that shows it. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, we'll do another mailbag segment on tomorrow's show on Tuesday. Give us your questions, thefinalbar@stockcharts.com. Nothing is out of bounds. Something about technical analysis, about behavioral finance, behavioral biases, particular markets or tickers. Just shoot us an email and let us know. We'd be happy to look at it for you. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.